want to talk markets as we get ready for this September jobs report this Friday. Joining us right now is Ed Yardeni, Yardeni Research president. Good morning to you.
Good morning.
You want to talk jobs? You want to talk jobs ahead of this week? What are we actually going to see? Because I think it's going to have maybe an impact on at least the Fed's thinking a bit, probably not this month, but then also may have an impact, frankly, on politics in this election cycle. So what are we going to see?
Well, I think the consensus is that we'll see something like 140,000 increase in payroll employment, which would be better than what we have seen on a three-month average. I think the three-month average was 116,000. But wages have been rising faster than prices, so real wages are up, and that's really why consumer spending continues to increase. You know, employment is on the margin. If we have 140,000 on the margin, that's a good thing. But if we have a real wage increase, if wages are increasing faster than prices, that affects everybody, and that's in a positive way.
So how do you think the Fed thinks about that piece of this equation, right? There's the inflation component, there's the employment component, but if we're really talking about the wages component, that's actually sort of a different overlay.
It is a different overlay, and the Fed really hasn't emphasized that much. You know, I've been doing this for a while, and one of the old adages that does work is don't fight the Fed. And the Fed, particularly Fed Chair Jerome Powell, has come across as very, very liberal on the mandate. He's concluded that the mission has been accomplished in terms of bringing inflation down. And now the fight is to make sure unemployment doesn't go up. But it's well meant. But the reality is layoffs are extremely low. The economy is actually doing quite well. It's just that the number of job openings has declined. And so people are staying unemployed longer. And I think the Fed perceives that if they lower interest rates, they'll create more jobs. And they could. But I think there's also a skills mismatch in the labor market. And if that's the case, then a lot of this liquidity that's being poured into the financial markets, not just by the U.S., but now by China, is going to continue to drive stock prices higher. And that, I think we're already
in the early stages. But speak to the skills mismatch piece of it. Is that just here in the U.S., you think, or you think that's everywhere?
I think it's probably everywhere. I think clearly our economies on a worldwide basis have become much more high-tech. That's where growth is coming from. Goods production is already highly automated, and now we're going to probably have robots increasing the productivity in the manufacturing sector. So what we really need is a lot of very skilled workers, particularly in the area of technology, or at least with a technology background. And if that's the case, we have a lot of work to do to augment the productivity of workers with technology.
Okay, so what is your betting line for the Federal Reserve through the end of the calendar year 2024, and speak to what we may see or not see before or after the election?
Well, I think I'm in there with the consensus. Again, I'm not going to fight the Fed here, and the Fed's very much committed to keeping the economy growing, which is a good thing. So I would say 25 basis points in November, and then maybe not in December. I think
not in December.
Maybe not, because I think the economic indicators are going to remain strong. I mean, we all saw last week that the economy was revised upwards. GDP is up stronger, gross domestic income is stronger, and most importantly, personal income turned out to be revised up, and people are saving more, and yet consumption is held in awfully well. So I think the economy is growing 3% in the third quarter. It'll do that in the fourth quarter. And I think the Fed's has already done quite enough, but it's going to do more based on what they're saying, and 25 may be it.